All right, Jeff, back to money flows very quickly and the preference and the attraction of shorter duration stocks. That would mean, because you're going to find more of them in international markets, are they not? We've seen a lot of money flowing into Europe. What about this part of the world where we are, though, the Asia Pacific?
Yeah, that's true. So tech is probably the classic long duration sector. And, U.S. stocks are definitely made up a lot more of long duration companies than shorter duration. As we look in Europe, say, there's a lot more shorter duration stocks. In Asia, there is more tech exposure and therefore a bit more of a long duration. But there's a difference between long duration tech and short duration tech. There's a lot of companies that have a lot of current cash flow that may benefit from an environment of rising interest rates. We've seen some of them hold up relatively well. They're the less sexier areas of technology. But even in tech, you can find some short duration stocks. But I think that causes me, as I look around the world, to continue to favor Europe. And that's an area that's outperformed this year, may continue to do so despite a rising dollar, which has been shaving off those returns as we look at it back here in the U.S., still able to keep up and actually outperform the S&P 500 despite a 9% rise in the dollar this year.
Jeff, do you reckon the value opportunity is more compelling over here amongst the Chinese internet names compared to their US large cap peers, the FANGs?
There may be more value there. There may also be more risk. It's so difficult to try and figure out what the next move is. We know the regulatory environment is faded, stimulus is kicking back in, but it's very difficult to understand what this might look like as maybe stimulus begins to pick up and growth begins to turn around again. I'm not sure that we're going to see a real retrenchment, and there's still a lack of clarity around some of these new regulations and what these businesses may be able to do. So while there may be value there, I'd be cautious in the size of positions that you take on.
Jeff, real quickly before we let you go, let's get to the real money question here. I mean, the big risk to the story that we've been talking about, the preference for shorter duration stocks, is, of course, if the market starts pricing in terms of outlook, lower rates should there be recession. And obviously, you're watching very closely for leading indicators of that. What would you be watching? What are you watching most closely now?
I'm watching a couple things to signal early signs of a recession. Of course, the U.S. Treasury yield curve is very important. I don't like to look at, let's say, the 2 to 10 or the 3 month to 10 year. I like to look at them all. And if you look at the 60 different yield spreads between short and long duration, only about 7% of the Treasury yield curve is inverted right now. It got up to 15% last month. So not yet signaling an imminent recession. That's a good leading indicator. I'm also looking at the difference between inflation and the unemployment rate. Whenever those two converge or cross over each other, it's often a sign a recession might just be a year away. That one is signaling some threat here with the U.S. inflation rate well above the unemployment rate. That's also true in Europe, true in Germany, true in the U.K. So I'm watching that very closely. So getting mixed signals on the recession picture, which keeps me on watch. But you're right, those short duration stocks have performed very well. That could reverse if we start to see yields plunge again on signs of an emerging recession.